Let's take a look at Chapter 15. Chapter 15 is about owner's equity. And some of this is kind of like every chapter. There's a few things that we go over that you've most likely seen before, but then we always add something new to that too, and something that I'm sure you haven't seen before. Kind of remember we're looking at things from the lens of a financial analyst also, so that should hopefully kind of frame how we look at this to some degree. So these are the major topics we'll look at this week, and a few more right there. So, an overview. So, again, we're kind of thinking of I'm an analyst and I am looking at a company's financial statements and we're trying to understand certain things, right? Especially when we look at owner's equity. So, keep in mind net income, as we all know, makes owner's equity go up. And also, it mentions here why are bond interest payments an expense while dividend payments are not an expense? Well, that's a good question, right? Because one's debt and one's equity, that would be part of that. Compliance with contract terms and restrictions. We'll talk about what a hybrid security is, if it should be classified as debt versus equity. That came up in the previous chapter a little bit also. The legality of corporate distributions to owners. How much can you legally distribute as dividends? And the linkage to equity valuation. So things like stock options, stock warrants, convertible securities, how do they affect earnings per share, stuff like that. So again, if we're an analyst looking at a firm, these are all potential questions we'll look at, things that we need to think about as we develop an understanding of the company that we're analyzing. So what is the firm? Uh, Under the GAAP view, the firm is the net capital deployed. Okay. So assets minus liabilities equals owner's equity. Okay, so assets minus liabilities equals owner's equity. We all know that assets equals liabilities plus equity, but we can rearrange that formula and go asset minus liability also equals owner's equity. Okay, so that's kind of what we're looking at. Owners are the insiders who provide net capital. Net income or loss arises from transactions between the firm and outsiders, people that are not owners. Banks and bondholders are outsiders, so interest cost or expense. However, shareholders are not outsiders. They are actually owners of the company, so they get dividends, which is not an expense. So that answers the question, why is interest an expense, but why are dividends not an expense? So that would explain why. And remember that dividends directly reduce equity, whereas interest expense reduces net income, which ultimately reduces equity. So as a result of some increase and decrease in owner's equity are considered to be income or loss, while others are increase, decrease, and not income. So we'll look more at those, some of these things that are affected down here in a bit. Okay, so now let's talk about accounting for transactions with shareholders. So these are owners of the company, stockholders, and some of this should be familiar. We talk about this in principles, we talk about this in the media a little bit. You should know what common stock is. That gives you the right to vote for the board of directors. It gives you the right to receive a dividend if the company declares one. The par value is usually very small. It's also called nominal value or face value. Typically, a very small amount, a dollar would be even high nowadays. Limited liability. And the reason for this is the risk of loss is only the cost of your investment. So if you buy a share of Costco for $100 and a year later Costco goes bankrupt, that the maximum you'll lose is the $100. You cannot lose more than that. So it's kind of attractive to investors, right? I can only lose my investment, but not more than that. If I'm, so as an owner, that's okay. We should be okay with that. Obviously, the odds of Costco going bankrupt in a year are pretty small, so you got to think that through too. And this is the journal entry to record new shares. Should look familiar. All of you have done an entry like that in the past. I know that you have. And then what companies can do is repurchase their shares. Okay, so they can buy their shares off the market. They can just go out and buy shares back. Now, before a corporation can do that, they have to receive approval from the board. So the board of directors has to approve stock repurchases. Now, shares are repurchased for a lot of reasons. Sometimes companies will spend billions of dollars buying shares back, and they do that to reduce the number of shares that are being actively traded, which then increases the stock price. They also do it just, they might buy some shares in order to be able to give out stock options and stock based compensation, things like that. So, lots of reasons why it happens. But keep in mind when you do this, you reduce equity. So, I want you to recognize that the treasury stock account itself is a contra equity account. So, by contra equity, what we mean is a debit balance. So equity is a normal credit balance. Contra equity has a debit balance. So, that's the difference between them. And this is the cost method. So that's one way we just deduct the cost of the shares directly from equity under that method. Um, so just giving us an example here, and then we bought $9,600, 200 shares at $48 each. And then it says several months later they resell 100 shares at 53. So they bought 200 shares here. We're going to sell $100, or I'm sorry, 100 shares back to the marketplace, and we're going to make $5 per share basically. So that's paid in capital, that difference between the 48 and the 53 times 100 shares. So we credit treasury stock when we sell it, and we credit it at its cost, and we debit cash for the amount received. The difference is a paid in capital from treasury stock. So we don't recognize gain or loss on the income statement, but we can increase equity for this amount. But there is no gain or loss on the income statement for treasury stock. Let's just say they sell the remainder, the last 100 shares, for $40 per share. And when they do that, they sell them at an amount below their cost. So they lose $8 per share. And so the first thing you do is you mark down your paid in capital from treasury stock. Okay, so that $500 increase that we had, we take the $800 loss against that. And then once that hits zero, there's 300 left over. Then we reduce retained earnings for anything that was left over after that. So that's kind of one thing to keep in mind. And that entry should look familiar. You should have done something like that in principles. Now, what you can also do is buy your shares back and permanently retire them, basically saying, we're going to retire these shares and never resell them to the public again. So that's an option that you can do if you want. You don't have to, but that's something that you can do. I'll just kind of like take a look at these entries right here, and we'll do a lot of homework examples also that'll help you out. But that's just one example. So, why do companies rebuy their shares off the market? Well, some of your employees are getting compensated with shares. That's one reason. If you really do think that your shares are undervalued on the marketplace, you might then make some money. You're not going to make a capital gain, but you can still increase your equity and increase your cash position by buying shares low and selling them high. That would be something that you can do. You're worried about a takeover, and the fewer shares that are out there on the market means it's harder for somebody else to buy those shares and get enough shares to influence the board of directors to potentially take you over. And then distribute surplus cash to shareholders. They're taxed at lower capital gain rates. So sometimes you want to reward your shareholders, and so you offer to buy shares back. And they don't have to sell to you; it's their option. They don't have to. But if they choose to, then they might. It's kind of like putting money in their pockets, right? And the capital gain tax rates are lower than normal tax rates. So there's an advantage for your shareholders potentially if they choose to do that. These have really grown, and this is a little bit old data, unfortunately, but this goes back to 2014. But if this was newer data, you would know that this has gone up even more. So this has really significantly increased over the last few years. And now that we've had the new situation that we're in, I've read a few articles that companies are kind of regretting giving so much cash back to shareholders. It's one thing when the economy is booming like it was, is companies have a lot of extra cash, and so they've got incentives to give that cash back by doing buybacks or doing bonus dividends and things like that. So, unfortunately, what may happen is you don't have a lot of cash left over as kind of a rainy day fund to get you through an economic downturn that nobody was expecting. So, there have been a few companies I know that have kind of regretted doing a lot of stock buybacks and whatnot. But also they're done to boost earnings per share. So EPS is earnings per share, and earnings per share is reported on your financial statements. You're required to by GAAP. So GAAP says you have to disclose this. And typically what you do is you put this at the bottom of your income statement. So that's a perfect example. The fewer shares there are floating around, guess what happens to EPS? Well, it goes up. We all know the math on that. They're showing us that right here. So, the earnings doesn't change when you buy stock back. And keep in mind, when you buy stock back, you don't pay yourself a dividend. That makes no sense. So, it's fewer shares you have to pay dividends on if you buy shares back also. That's one more reason. So, raising EPS would be another one. And then also, we have what they call equity-based covenants and preferred stocks. What does that mean? So owner's equity is one of the accounting numbers used in contracts with lenders, suppliers, and others. Some lending agreements will include some covenants that restrict allowable debt to equity levels. It's called a debt covenant. And so if a business has debt with a bank, the bank can say, we'll give you a loan, but we're going to put some restrictions on some decisions that you can make because we want you to have a certain amount of equity. We want you to have a certain, we don't want to go crazy taking on a lot of risk and you can't pay us back. So we're going to put some limits in place that will restrict some of the decisions that you can make. And that's what they mean by with this information right here. So preferred stock is the next one. So we're moving on from common stock to preferred stock. And it says here, preferred stock confers certain preferences, and the preference is dividends. So if you have preferred stock, you receive dividends before common shareholders receive dividends. Now, the caveat, though, is your dividends are capped. They can only be a certain amount, whereas common shareholders do not have a cap on the dividends. Also, if you're a preferred shareholder, in order to get that preference for dividends, you give up your right to vote for the board of directors. So you don't get to participate like a common shareholder would. So you're giving up one right for another right. So, and the right basically is to get dividends. And the way that works is the par values on preferred stocks are typically much higher than they are for common stocks. And typically you get 8%. You get some percent. So, 8% on a $25 par value preferred stock means you get $2. And that's capped. You cannot get more than that. And quite often with preferred stockholders, if the company could not afford to pay dividends in 1 year, the dividends are in arrears, meaning that the company has to catch them up. They accumulate. Whereas common stock, that's never a situation where that would be a thing. Okay, so preferred stock helps, especially when it comes to compliance with contractual terms, because it's less risky. Debt, if you miss a debt payment, if you miss a principal payment or a interest payment with debt, that could trigger a bankruptcy proceeding. If you have preferred stocks and you don't pay a dividend, that will not trigger a bankruptcy proceeding. So generally, a company can forego dividends for a few years and not worry about lawsuits and bankruptcies. Now, you can't do that forever with preferreds. At some point, you need to pay your dividends because people will get restless. Your common shareholders will not be happy because they'll never get a dividend if there's a whole lot of preferred dividends that are in arrears, for example. So, but it does give the company more flexibility than debt, and that's kind of the advantage of having preferreds. You can also issue preferreds that are called mandatorily redeemable preferreds. So preferreds are typically either redeemable or non-redeemable. And if they're mandatorily redeemable, then they kind of look like debt. And we talked about that in last week's chapter. So the challenge with these is we have to report these as a liability. So that's something that's new. has not been around forever, but this is maybe about a 10-year-old kind of a rule. And I think the FASB kind of realized that companies are kind of manipulating numbers a little bit with this. So they felt like this really looks more like debt because it's kind of like a bond, right? You sell a bond, you pay interest, and then when the bond matures, you pay the principal back. And this works the same way. You sell a redeemable preferred, you pay your dividends annually, and then it's mandatorily redeemable, meaning I have to buy it back when it matures in 5 years or 10 years, whenever it would be. So it's kind of one of those things. It's like that. It's almost the same thing as a bond. So the FASB has said you got to classify that as debt only if it's mandatorily redeemably preferred. Okay. And then dividend distributions. Now, keep in mind that there are typically limits with the amount of dividends you can pay. Now, we're talking more publicly owned corporations. If it's a family owned corporation, closely held, only a few people own it, different story. Okay. This is publicly owned where anybody can buy shares of this company's stock off of a market. Okay. So that's different than a privately held company. Completely different story when it comes to dividends. Also, keep in mind whatever your business is, that may also impact um, your limits on dividends. Um, so with that in mind, let's kind of look through the process or think through the process um, um, of dividends. So, like I worked for an insurance company, and insurance companies, before they can pay dividends, have to get approval. Now, it's not that way for all publicly owned companies, but banks, insurance companies, some of those have certain regulations that will require that. Okay, so those are just kind of some of the things to look at. So, most have this revised Model Business Corporation Act, which kind of acts as a guide for things like this. So stock dividends and stock splits, that's something that you should kind of remember also. We cover these in principles and intermediate. So kind of think through why this happens also. Companies don't always have the cash to pay dividends, but they want to reward their shareholders. And so a way to do that is either by giving them more stock by doing a stock dividend or splitting shares, put more shares of stock in their pockets. So it's a way to reward your shareholders to some degree, but actually not have to pay cash. And distributions, dividends kind of have a threshold of 25%. And so if a small stock distribution, less than 25%, is treated differently than a large distribution above 25%. And in your homework, they'll tell you that. Okay, you don't have to guess in your homework; they'll let you know what that's like. And then stock splits is a way just to put more shares into somebody's hands. So, like an example, it's been about 8, 9 years, but Apple used to trade for $700, and Apple did a 7-for-1 split. So if you owned one share at $700, the next day you own 7 shares worth $100 each. So the value of Apple in total didn't change, but you now had 7 shares that traded at 100. And the reason that companies do that, it makes the stock more marketable. If the stock's valued at $100, it's more likely to get bought and sold. Amazon is a perfect example of a stock that I don't know the last time they did a split if they ever have, but his stock value pre-pandemic was over $2,000. So they've never done a split. Should they? I don't know. Would it trade more if they did a split? Of course it would. It definitely would. But those are some things to kind of think about when it comes to splits and dividends on stocks. And then this is this kind of a slice and dice of the equity section of a corporation. This is Marriott Vacations, for example. And you can see they don't have preferred stock. They've got it authorized, they just never have sold it. They've got common stock, and the par value is a penny. That's very common. They've got treasury stocks. Notice it has brackets around it as a subtraction. Additional paid in capital. So money's paid above par value to buy stock. Comprehensive income, retained earnings, and then you can see what their equity has been for 2 years. Okay. Now, also then, so that's kind of the slice and dice you see in the balance sheet. And then this is kind of um, the changes of every single component of equity that the company had in the year. I used to put these together. And when you hear the term OCI, it's also called AOCI. So either other comprehensive income or accumulated other comprehensive income, either way it works. And these are things that affect equity that the company doesn't really control, if that's probably the best way to say it. Net income, a company controls. A company's making decisions about revenues, about expenses, about product lines, all those kinds of things that directly impacts net income. But other things happen that are just caused by the economy that a company has zero control over. And foreign currency translation adjustments would be a perfect example of that. If a company like Marriott, which has worldwide operations, and so it's based in the U.S., but it has properties across many countries across the globe. Well, when it's working internationally, it has to bring back those amounts from foreign countries back into the U.S. dollar, and there's that fluctuation, that valuation changes all the time. Okay, that changes all the time. And so, with that in mind, that Marriott has no control over that. Now, Marriott can do certain things to protect itself from major losses and stuff like that, but you're always going to have those valuation adjustments. So that's what they call other comprehensive income. There's other examples of that too, but for Marriott, that was the only one that they had on their financial statement. And then we also talk about capital structure. And then when you read a company's statement of equity, some things to keep in mind. Not all the time does a company issue all the shares that it has authorized to share. Sometimes it does, sometimes it doesn't. But also, it makes quite often companies have different levels of stock. This is kind of a made-up company right here, but they've got two different stock issues. They've got one with 160,000 shares, one with 200,000 shares. And that's not unusual. So or they sold 40,000 shares during the year. So that's not unusual for that to happen. So they sold 40,000 shares during the year. They went from 160 to 200 between January 1 and December 31. Okay, so this kind of just walks you through, and that's what you do with equities. You just have to reconcile the beginning number to the ending number. Okay, and then when that's the case, so that company's equity structure changed during the year, and so what that means is that you have to do what they call the weighted average shares outstanding. And so you can see here earnings per share, the calculation. You take your net income and you subtract anything that would be preferred dividends. So net income minus what the preferreds get. So anything left afterwards, then you divide that by the weighted average number of common shares. Common shares. And you can see here we did the weighting. For this example, it was 2/3 was 160, 1/3 was 200. The weighted average is 173,334. And that helps us figure that out. Okay, and then diluted means if we had convertible securities, we had stock options, we had debt that could get converted into common stock. If we had things like that, what that means is that if those are all exercised, that would dilute. That would mean there'd be more shares outstanding, and that'd be called your diluted shares. And so that would lower EPS. So diluted EPS would be lower than it would be for just regular EPS. But you have to also put that into your financial statements. Have to show that number. Then more of a complex capital structure here. So now Solomon, let's kind of ratchet that up a notch. They've got 5% convertible debenture bonds. These bonds can turn into shares of stock. So each bond can turn into 10 shares of stock. So we have to use the if converted method now, and that makes the computation a little bit tougher, obviously. And then the question here is EPS a meaningful number? Well, that's debatable to some degree, I'm sure. Um, but generally we have to disclose it. Okay, it's something that we're required. GAAP says you must disclose this. And what they're doing here is they're giving us two different companies that have the same earnings per share. Okay, and you can see, they both have up here the same net income, the same weighted average number of shares. Then we get down here, assets are different, liabilities are the same, but now equity is different because assets were different. And so ROE is very different based on that. And generally, so if you only looked at the earnings per share number, you would think, well, there's no difference between companies A and B. But ROE, the higher the better. Okay, if we want that number to be as big as possible, we would choose company A because it's better off, right? So that would be the reason for that. So it's more efficiently, company A is generating more earnings. It's more efficiently generating earnings from existing resources than company B does. So that's the reason for that. That's why we choose it. And then something that's probably new that you really haven't necessarily seen before is accounting for share-based compensation. So it says here several companies use stock options to augment cash compensation for several reasons. Obviously, it's less cash, right? Especially for a newer company. So a lot of startups will do this. They will promise to new hires and executives, hey, if you come over here, you put in your blood, sweat, and tears. We can't pay you a lot, but if this company takes off, these stock options you can exercise are going to make you a millionaire. So there's a reason that you do that. Plus, there's a tax savings to that also. So those are very common, but even established companies can use them also. It doesn't have to be a brand new cash starved company either. So in GAAP, when you have stock-based compensation, you have to have some key provisions here. So companies must record the cost of employee services received in exchange for a stock option. The compensation cost is determined by the award's grant date fair value measure. Basically, what's the value of the stock when the stock option is granted, and then we recognize that as an expense over a vesting period. A vesting period means you might have to work for a company for so long to get the rights. But basically, just think it's still an expense on the company's income statement when they issue these. But the difference is that we don't have to pay cash for them, and that's the key. That's what saves companies some money. But we do have to recognize some expense here. So, really good example here for you to walk through. I don't have to talk you through the entire example, and we'll do that when we do some problems. We'll do some problems together about this kind of stuff. But this is a great example, same one that's in your book. So your book and the PowerPoint are exactly the same. And you can see here, the fair value stock options is measured at the grant date, the date that both the grant's terms are set, and the stock options are awarded for individual employees. So assuming that each option is a fair value of $10.05 at the grant date, the total compensation cost of all employee stock options is 30,000 options times 1050 or 1005, and you get the journal entry down here. So you debit compensation expense and you credit paid in capital for stock options. Okay, so that's the entry to do that. And of course, that will impact your earnings per share. So when you do your earnings per share computation, you have to take that into account also. So just kind of more of an FYI with that one. And then the date of exercise, when options are exercised, that requires another journal entry, obviously. And you can see then that's where somebody is going to buy the shares kind of at a bargain, more or less. So down here, we're debiting cash when the options are exercised. Employees are buying them at a bargain, $30 when they're worth 42. And you can see it's $900,000. We had the 3015 from the previous journal entry. We credit common stock at par, $20 par at 30,000, and we get a credit to paid in capital for the difference. Okay. Then also keep in mind that we can have debt that's convertible into stock. Okay. So in this example, $400 million convertible notes paying 4% interest. They mature in 5 years, but investors can turn them into 44 shares of stock. Smithfield Foods offers investors the opportunity to purchase up to $400 million worth of convertible notes. Investors paid $1,000 cash for each $1,000 face value, 45% convertible debt security, and then the cash flows, which is principal discounted, were 772.55. Investors were willing to pay more than that though. So the present value was 772.55. So the discount was 227.45. Why were they willing to pay more? Well, because of the conversion. That's why, because they can be converted into stock, and that has value. Okay. Also, notes can be callable or redeemable before maturity as part of the contract when these kind of securities are issued. So that's always something that might happen. Convertible debt is a common form of borrowing. GAAP specifies that convertible bonds must be recorded at debt only with no value assigned to the option privilege. So there's one thing to kind of think about. And there's a few more journal entries. GAAP permits companies to record debt conversions in either of two ways, the book value method or the market value method. So obviously the market value method, then the difference between market value conversion price is either a gain or a loss. That's the big difference between the two of them. Okay, so some information, probably the stock-based compensation stuff was probably the newest, maybe a few variations of earnings per share that might have been new to you, but a little bit shorter chapter, thankfully, this week. Hopefully it helps you out. If you have questions, just let me know.